We have those core data now that we were looking for. The PCE core year over year is 1.9%, right on the dot with what was expected of it. Similarly, month over month, the deflator overall, apart from core 2.0, it's really right on what we expected. Personal income is 0.3% gain as opposed to 0.4%, which is what the estimates were. And personal spending is 0.4%, right on where it was thought to be. So it looks like, Lisa, really just what we thought it would be, pretty much across the board.
And you can see that there isn't a dramatic reaction in markets just yet as we process these numbers.
Which would make sense. So now let's bring in Michelle Girard. She is NatWest Chief U.S. Economist. Jason Sabatke of Yatman Asset Management and Mark Okada of Highland Capital are still with us. So, Michelle, is this in line with what you expected?
Yes, well, I think, certainly the income and spending numbers were already incorporated into last Friday's GDP report. So not a lot of new information there. We're very focused on the inflation numbers and that core PCE deflator rising on a year-over-year basis back to 2%. Back to the Fed's target level. I mean, it's well anticipated. We've all known that when those low March 2017 readings fall out of the year-over-year calculation, we were going to see a sharp acceleration. But I think it's meaningful that we are back at 2%, the Fed's target. It's a couple months earlier than we had expected at the start of the year.
Okay, so Michelle, is this mission accomplished for the Fed, and does this mean 4 rate hikes this year?
Well, that is our expectation, that we will continue to see the Fed moving gradually, hiking once a quarter throughout 2018. I tell you, one of the things I spent a lot of time talking to our customers about is it's not so much about what they do in 2018. It's not do they hike 3 times or do they hike 4 times. I think the bigger question is really what happens in 2019 and beyond. What happens as the Fed gets the funds rate up close to neutral? Do they have to keep going? Do they have to take policy into restrictive territory, or are they okay to just stop once we get policy back to neutral? Ultimately, I think that's the bigger question in terms of what's going to be happening in terms of market yields and how high they may or may not rise.